Let's take a look at the impact of inventory methods on financial statements. During times of increasing inventory prices, which were the examples that I showed you earlier, during times of increasing inventory prices, FIFO gives the lowest cost of goods sold because FIFO is based on older costs which are less expensive. LIFO, last in first out, gives the highest cost of goods sold. And that is because LIFO is based on the more recent costs, which are more expensive. So if you write off your more expensive items first to cost of goods sold, LIFO gives you a higher cost of goods sold. Your ending inventory has the opposite effect. If you use FIFO, your ending inventory has a high value because it's based on more recent purchases. If you use last in first out, your ending inventory has a lower cost, and in fact it has the lowest cost of the three methods because it's based on older costs, which are less expensive. During times of decreasing inventory prices, the opposite will happen. I'm not going to talk too much about decreasing inventory prices because currently we are going through increasing inventory prices. In periods of increasing prices, companies that use last in first out has a tax advantage. LIFO results in highest cost of goods sold, which results in lowest income. If you have a lowest income of the three methods, that lowers your income taxes, and that means that business owners have the cash available to expand their business or use it for other purposes. There are several issues with last in first out where companies can manipulate net income. Let's say, for example, when inventory prices are rising, a manager can purchase a large quantity at the end of the year at the highest price so they can lower their income tax. On the other side, sometimes liquidation can occur, which means you can manipulate your purchases so that the purchases you buy are less and less from last year. So you dip into older layers to make sure that your income looks good. Therefore, since companies can manipulate net income using last in first out, LIFO is not allowed under international financial reporting standards. Remember, sometimes LIFO liquidation needs to occur because you want to get rid of those old, outdated inventory layers, but sometimes it does allow manipulation by managers who want to show a higher net income in a particular year. So your financial statements may be manipulated when using LIFO as your inventory costing method.